Hi, my name is Alex Carlucci with Gustan Associates. I am going to talk to you today about how business news and politics and Federal Reserves affect interest rates, stock market. So let's start off talking about the Federal Reserve. So when you hear the Federal Reserve is going to cut rates, that means that they're going to cut the short-term rate. Now the short-term rate has nothing to do with the actual mortgage rates or the 10-year notes in terms of cutting the mortgage rates. What they're doing is they're cutting the overnight rate that banks borrow from the government when they have to keep their deposits at a certain level. So if you have so much money in your bank, you have to have a certain amount of cash in your safe. So if 20 people want to withdraw all their money, they'd have a certain percentage of it there. So let's make up a story. Let's say you have $100 million of deposits in the bank, and let's say you have to carry 5 million of it. Well, every day, at the end of the day, they have to count how much money they have actually on hand, and if they're short, they'll borrow that money overnight from the Fed, and hopefully the next day people will make deposits and they'll not have to borrow it more, they can pay it right back. So it's called an overnight rate. And what that determines is how much money is being borrowed from the Fed. It creates a demand for the money, so it'll drive the rates down. So when they cut that rate, that means that there's no demand for it, so they want to increase the people borrowing from them. So when the economy is really bad and they want to stimulate the economy, they will cut that rate because they control that rate. What that usually does, it sends a ripple through all the rates, the 2-year note, the 10-year note, the mortgage-backed securities, the 30-year note. It doesn't directly change these numbers. The 30-year note could actually the rate could go higher if they cut that rate, because it's a signal that the economy is going to do well and therefore rates are going to go higher. It's really complicated formula, but in general, when they cut that Fed funds rate, then all the rates are cut. So hold on a second. So when they cut the Fed funds rate, all the rates generally follow, but not always, so you can't count on that. So when the Fed says that they're going to cut rates or talk about cutting rates in 6 months, the economy signals it way ahead of the actual cut. So what's going to happen is the rates are going to get better now, and then the day that they cut rates, the rates can get actually worse, the day of actually cutting it. It's very counterintuitive. So the market works in funny ways. But if the stock market's dragging, the economy's really slow, and they cut rates, it sparks the economy. And when rates are lower, it causes people to have more money in their pockets, cheaper mortgages. Everybody's got more cash, and they go out and spend it, and it boosts the economy. So when the reason they don't want to cut rates and make them always zero is because the economy can run too hot. What that means, when the economy runs too hot, if rates were zero at all times and we had 0% mortgage rates, then there'd be no room to control an economy. So what happens in a zero or low rate economy is it could be inflationary, and that means that the prices of everything just keep going higher and higher and higher, where people can't afford it. The average person can't afford it. Only the rich people can afford the price of their goods now, because the inflation caused it to go so high. So the Fed's got that tool to control inflation and the economy. So if they want to stimulate it, they'll lower it. If they want to slow it down because it's getting too hot, they'll raise it. And the big number that they look at is an unemployment number to gauge if they want to raise it and lower it. It's one of the biggest gauges. So if unemployment's really good, they want to raise the rate because they want to slow down the heating of the economy. Because when the employment is really good and you're at full employment and they can't find anybody to work, then it costs more money for the next employee that you want to buy. You have to pay more money to get an employee, which causes inflation, which hurts businesses in the long run. So they're always trying to keep a balance between, inflation and a booming economy. They're just constantly trying to keep everything as smooth as they can, and sometimes it gets out of whack and goes one way, and sometimes it gets out of whack and goes the other way. It's too hard to predict. It's like turning a ship in a pond. You may turn it, but 5 minutes later it turns. Not right away, like a car, where you turn it, the car turns. It takes a while for all this stuff to work its way through. So that's what you hear about the Fed raising rates or lowering rates. They're really doing the overnight rate, but it does have a ripple effect through the whole rate board. Another thing is, you hear about right now in the economy, they're going to raise tariffs on China. What's happening there in China is that raising tariffs is going to stop China from taking advantage of America. So right now, China, we send our goods there and they put a 25% tariff on it. So our little knickknack for $1 cost $1.25 over there, and they're selling it for 50 cents over there, so no one's buying our stuff over there. And then when their stuff comes over here, we have no tariffs on them, so our stuff costs $1.50, and over here it costs $1 or 50 cents. So they're just selling all their goods everywhere because it's the best price and because we have no unfair trade rules. So the goal is to get that, to charge them tariffs on their goods, and therefore they're going to charge more tariffs on us. So there's going to be less of our goods going over there and people's buying it. So there's going to be a little battle of war. So that's going to put a little hindrance on the economy in the short term, and that's going to cause the Fed to maybe want to lower rates, or the reason that the stock market might feel some pain because the corporations are going to feel some pain. So those are some things that you're hearing in the news. So the Fed tries to control the rates, how tariffs are going to affect the economy, and there's tons of other news. So if there's a war that goes, if all of a sudden there's a war, or big bomb blows up in like a World Trade Center, the stock market falls because business is directly affected. So the stock market falls, the people buy bonds, which actually drives the rates down to stimulate the economy to make up for the lost business. So bad news usually means lower rates, and good news usually means higher rates. So I don't want you to wish for bad news out there, but just for a lower rate. But that's kind of what the general sense of what happens. So bad news will give lower rates, good news will give higher rates. The Fed controls it by lowering and hiring the Fed funds rate, and any type of business thing that's bad for business, like tariffs, will cause the stock market to go down and rates to get better. So look for that kind of stuff if you want to gauge it and understand what's happening in the economy. But that's the general sense of how it's functioning and how those things translate to lower and higher rates for mortgages. Thank you very much. If you like our video, please go to gustanshow.com. That's GUSTANCHO.com. Look at all our blogs. We got a bunch of other information. If you want to talk to me directly, call me at 630-915-7550. Thank you very much. Please like the video and share it.